Hello, Super Saver. I hope you're doing better than Treasury Secretary Janet Yellen and newly elected House Speaker Kevin McCarthy this week. So the debt ceiling, a potential U.S. default, and our I-bonds, T-bills, and other U.S. Treasury securities. That's what I'll be talking about today. Here's what I'll cover. Does reaching the debt ceiling mean the U.S. government will default? What happens to our I-bonds and other Treasury holdings if the government defaults? And what I'm doing right now with my money. Grab a bucket of popcorn, a coffee, water, or wine, and let's dive in. The short answer is no, not necessarily. And to understand this, we have to first understand why the debt ceiling was created, how the debt ceiling has grown over time, and what actually happens when the debt ceiling is reached. The debt ceiling has been a part of our constitutional checks and balance system since 1917, when Congress passed the Second Liberty Bond Act. This effectively allowed the U.S. Treasury to issue debt without Congress having to approve each individual bill or bond issue, so long as the U.S. Treasury stayed below the aggregate amount of debt, the debt ceiling, approved by Congress. As you can see from this chart from Treasury.gov, the U.S. national debt hasn't stopped growing for the past 100 years. We had a first spike around World War II, but then our national debt stayed under control or even went down a bit for more than 3 decades. From about 1982 to 2022, though, U.S. national debt skyrocketed, except for a short period of consolidation in the late 1990s. So the net result is that our national debt stands at a record high right now as I'm taping this video. It hasn't stopped growing and has crossed the $30.93 trillion mark that you see on this chart from the end of September 2022. It now amounts to $31.38 trillion as per mid-January 2023. And even if you compare our national debt to GDP, gross domestic product, which gives you a first assessment of whether the debt level is sustainable, a bit like comparing debt to income for a family. Our debt pile compared to GDP is above the previous peak we reached at the height of World War II. And if we zoom in just to the last 40 years, this killer chart from the Washington Post shows how precipitously the debt ceiling and national debt have risen over the past 40 years, with a particularly sharp boost in the prior years that include COVID. So is this sustainable? Drop a comment below and let us know what you think. So again, here's where our national debt stands at this moment, on Martin Luther King Jr. weekend, as I tape this video. By the way, that's roughly $94,000 of debt for every infant, child, parent, and grandparent, every person in the United States of America. The debt ceiling was last raised in December 2021 by $2.5 trillion to its current $31.4 trillion limit. And just a little over a year later, here we are now once more. We have this letter from Treasury Secretary Yellen to the recently installed House Speaker McCarthy informing him that on Thursday, January 19th, 2023, the outstanding debt of the United States of America is projected to reach the statutory debt limit again. And once the limit is reached, the Treasury will need to start taking certain extraordinary measures, as they call it, to prevent the United States from defaulting on its obligations. These extraordinary measures primarily entail the Treasury pausing certain retirement investments for federal employees. Once the debt ceiling is raised, though, these retirement investments would resume and be made whole. So these are not real spending cuts, but essentially pushing investments to a later date to preserve cash for now to keep the government running. Do note that these extraordinary measures are by no means unprecedented. According to Yellen's letter, Congress has expressly provided the Treasury with authority to take these actions. And Treasury secretaries before her have used these measures multiple times to stay under the debt ceiling while still paying for what they needed to pay for. Yellen estimates that these extraordinary measures should allow the Treasury to keep things running until early June, although the language regarding this timeline was rather vague, at least in my mind. The market had initially predicted that this would happen a few months later. I've linked the Yellen letter in any case in the description below for those of you who are interested in further details. So in a nutshell, hitting the debt ceiling is not good. More on that later. But it does not mean that the government will immediately default on its obligations to you, to me, and to all the other individuals, institutions, and foreign countries that own US Treasuries. Basically, even if the Treasury does hit the debt ceiling on Thursday, January 19th, 2023, by taking these extraordinary measures and relying on incoming revenue, primarily tax revenue, the Treasury can keep paying all its debt obligations for the time being, at least until June, according to Yellen. The issue is that these extraordinary measures and incoming revenue alone are not enough to keep things going forever because the Treasury is constantly running a deficit. For the 2022 fiscal year, this is how much revenue came in and how much expense went out. Imagine if that's what our personal cash inflows and outflows look like. You and I don't have a Congress, though, who can approve a nearly permanent deficit. The Treasury does. And that's why Congress has to raise the debt ceiling again so that the Treasury can continue to borrow to fill this spending gap. So, while simply reaching the statutory debt limit in itself this month does not mean that the government is going to default in January when that debt limit is reached, it does mean that they will run out of money eventually unless they cut spending or increase the debt limit and start borrowing again. What history has shown, though, is that Congress has consistently increased the debt ceiling over the past decades when needed so that the Treasury does not ultimately run out of money. As we've seen on the Washington Post killer chart before, Congress has indeed lifted the debt ceiling every time the actual debt reached it. Just take a look at this article, for example. Seeing the headline alone, you might have thought that this was a recent article, when in fact it was written during the last debt ceiling crisis in 2021. And there were also the debt ceiling crises of 1995, 2011, and 2013, just to name a few. That's not to say that those debt ceiling increases came without a fight. They usually did, and several of them even resulted in government shutdowns before an agreement was reached by both parties in Congress in the end. The House of Representatives on its website keeps track of 20 funding gaps when the U.S. actually hit the debt ceiling, and 10 government shutdowns since 1977, with the last shutdown in 2018 and 2019 lasting the longest so far at 34 days. Keep in mind that a shutdown is not automatically the same as a default. Even when it hits the debt ceiling, the government can use its incoming revenue from taxes and other sources to keep functioning. However, because the U.S. government currently only covers about 80% of its expenses from incoming taxes and needs to borrow fresh money to pay for the remaining 20%, which it can't when it hits the debt ceiling, the government essentially can run at 80% at best over a longer period of time when it hits the debt ceiling. So what it does is that it goes into what we call a government shutdown. The government continues to operate its essential services that it can pay for with incoming taxes, but it has to shut down some of its less urgent functions to preserve cash, meaning that certain government services do not operate and certain federal employees do not get paid, at least until the fight in Congress is over. That said, in all past shutdowns, the U.S. government always considered debt service an essential function. It continued to pay its debt obligations, and it continued to pay the interest on our I-bonds and other Treasury holdings in full. And they did this to maintain the full faith and credit of the United States. This time, though, as we've all seen from the 15 voting rounds it took for McCarthy to get elected as Speaker of the House, despite holding a slim Republican majority, we expect not just a fight. It's looking like a major battle, a major political battle over whether our government should keep spending and borrowing at the current speed, or whether they should start saving at least a bit more and borrowing at least a bit less. And a quick word about what all that may mean for the outlook on inflation. Remember, despite the Fed's rate hikes and quantitative tightening starting to rein in inflation, there's only so much the Fed can do if the government continues this pattern of spending and debt making that it's been on under various administrations, at least since COVID and probably before, as we've seen in the charts. Right. So we've seen that the US has run up against the debt ceiling multiple times since at least 1977 and gone through 10 government shutdowns in the same time period. And it's always ended well so far, with the government continuing its debt service through the shutdown, Congress ultimately lifting the debt ceiling, and the full faith and credit of the United States restored without lasting damage. But what if, just what if, this time it's really different? What if Congress really doesn't increase the debt ceiling? What if the government does run out of cash, and instead of just going into a government shutdown that would still maintain the debt service like in the past 10 instances, the government decides to actually default on its debt in June? You're not going to like this. I don't like this. But if the government really defaults, which has never happened before, despite all the debt ceiling crises of the past, but if the government really defaults, our I-bonds and other Treasury holdings are basically worthless. That money is gone. The government wouldn't be able to pay us the interest it owes us on those debt obligations, nor would it be able to pay us back any of our principal. Think Argentina debt crisis, just at another bigger, more global level. And that's why I personally don't think it will happen. There is a reason why US Treasury securities are considered risk-free for all practical purposes. Why the US Treasury market is the most liquid market in the world. Why the term flight to quality refers to the move into US Treasuries during uncertain, volatile times like the ones we're currently in. All of it is based on the US government maintaining its full faith and credit through good and bad times. And while I could be wrong, I don't think that the administration and Congress would really destroy what's been created over the past several decades. And never mind the fact that this would significantly raise the government's cost of borrowing in the future. This was exactly what happened one of the last times the US nearly hit the debt ceiling in 2011. S&P Global Ratings downgraded the US from its highly prized AAA rating for the first time ever. Borrowing costs increased dramatically. Investors' and consumers' faith and confidence in the US was shaken. Understandably, markets tanked, retirement savings took a major hit, and that's the last thing you, I, businesses, the US, and the world needs after a year like the last one. Having said all that, with the major political battle that's currently going on in Congress over continued spending versus conscious saving, I do think that 2023 is going to be another rocky year for our money. And I do think that there is a certain chance that we may see a government shutdown as we get dangerously close to that debt ceiling before something or some party gives. And I also think that along the way, there will be a fair share of fear-mongering headlines and media that will cause folks reading that stuff a lot of anxiety and concern. But personally, the possibility of a full US default is really not something that keeps me up at night right now, for all the reasons I've already mentioned. The government doesn't want its credit rating downgraded again. It does not want to increase its borrowing costs further. It does not want to create widespread financial panic and turmoil. And because, as I've always said, and as I continue to believe, if America ever went bankrupt, we'd have much bigger problems. The world would have much bigger problems. And as much as all individual members of Congress and the administration want to achieve their own goals, I can't believe any one of them would want to go down in history as the one that broke the US economy and ripped apart financial markets globally. So, I am operating under the assumption, based on what I believe and currently know, that we will somehow, in some way, avert a government default, even if there will be a debt ceiling standoff in Congress, and even if we may see a government shutdown, and even if there will be some possible unforeseen ups and downs along the way. I do think that debt service will continue through all the political drama. So we're not doing anything differently with our money right now. As I've shared with our community in this recent video here, we're still laddering our T-bills given the Fed's December messages that they will continue with rate hikes in 2023, albeit at a slower pace. None of my T-bills have a maturity past May at this point, but this was by sheer coincidence. We're also still holding onto our I-bonds. Not a hard decision there since we can't redeem any of them yet. But I'm not rushing to cash them out in any case because we're still earning 9.62% on an annualized basis on our I-bonds. And we're continuing to dollar cost average our retirement savings into the stock market. But this is me, sleeping fine at night, not overly concerned about a government default at this point. As I always say, everyone's financial journey is different. If you, on the other hand, are concerned about a government default, one option might be to ladder in such a way that you don't have any maturities beyond May, or to get out of government debt altogether. Just keep in mind, though, that if the US does default on its debt, there really is no good place left where an investor can safely park his or her money because US Treasuries, they're supposed to be that safe place. A government default on US debt obligations will have significant ripple effects on nearly every other asset class, with gold and real estate as possible exceptions. But gold prices have gone up significantly in the past few months, and real estate requires a lot more capital. So these options don't work for everyone. But do keep checking in for the latest updates. I'll let you know my current thinking as things evolve. If you are interested in learning more about some of these other asset classes, then drop a comment below and let us know. All right, Super Saver, I hope this video helped you better understand the current debt ceiling crisis and how that impacts our I-bonds, T-bills, and other Treasury securities. As always, if you enjoyed this video, then don't forget to share it with those you care about. And of course, to hit that thumbs up, and see you again very soon with another brand new wealth building video.